So, I have a pet peeve and it's private equity. Let me tell you about it. So, private equity seems to be devouring the economy right now. 20 years ago, it was almost nothing. And as of this year, it accounts for about 8% of the entire workforce in the UK and in the US. It's very similar, a little bit less in Europe. And in the next 4 years, it's predicted to double. There are two main problems with private equity, and the first one is misaligned incentives. It sounds neutral, but it's really not. It means private equity is not actually interested in the long term viability of the companies it manages, or the people it employs, or its customers. So, what's the result of not these misaligned incentives? Basically, it massively scales up the risk of bankruptcy of companies that private equity takes over. So there's actually 10 times the rate of bankruptcy in private equity owned companies compared to the general economy. That's massive. Looked at another way, 1 in 5 of all private equity flip companies they own, go bankrupt, like whilst they own them or, within a short time frame afterwards. Um, the second cluster of problems, we'll call it, is systemic risk. This isn't just risking this particular company and all its employees and customers and the local community that may rely on it. It's also fundamentally restructuring how we finance and how we invest in it. So basically, private equity use massive amounts of leverage, debt, not equity, to buy up equity. So they're injecting massive amounts of debt that wasn't there to buy up already existent assets that were fully owned. And then once they have bought the company, they also tend to load that company with loads of debt, often merely to funnel that money back to investors and the PE partners, and leave the risk with the company. So there's this massive scaling of debt. It lacks transparency, because over the years, the debt is no longer just coming from sort of institutional banking, things like that. It's actually, we're seeing the kind of scaling up of private credit, which is a similar sort of thing to private equity, but it's just sort of privately very wealthy people wanting to perhaps diversify risk. I'm not sure how much they're diversifying by providing debt with a kind of interest rate, fixed or floating, rather than just equity. It is what it is. And the reason why this is problematic is that these funding sources are there's less oversight, there's less transparency. So our central banks and governments don't have the same understanding of where the chips are in the economy, where the risk lies. And that is really scary because we know we're building up lots of risk, but we actually can't quite quantify it or appreciate it. And that is the general gist of one of the latest BOE risk reports, which is quite frightening. Okay, so I mean, you might be like, okay, Lucy, I understand you. This sounds terrible, but what the fuck is private equity? And I hear you. So, private equity basically aims to buy out companies and flip them, kind of like you flip a house, increasing the value as much as they can in a kind of 3 to 7 year turnaround to massively scale up valuations. And they do this through really short-termist focus on maximizing profits in the short term. Okay, I mean, cool, but why is it called private equity? Isn't all equity freaking private? Yes, it is. Basically, there was a period in the 80s where this kind of thing was called leveraged buyouts, and it just got such a toxic reputation that they had to rename it. And so now it's called the innocuous sounding private equity, but it's still leveraged buyouts. The general MO is private equity generally buys out a target company with around 30% in equity from investors and 70% with debt. So what they're doing is they're basically converting equity with its higher return profile into mostly just debt, which you may have noticed over the past sort of 15 years has been at rock bottom interest rates. And what this allows them to do is sort of artificially or financially engineer a higher return on a smaller investment, because they're they're funding the bulk of it with pretty much free money, cheap debt. Okay, so what are some of the tools they use to create these stratospheric returns? So we've already touched on the leverage buyout, 2, loading the companies with debt, 3, asset stripping, so selling, say, land and buildings that they may own outright to another property company, which they may then sell, and then forcing the company to lease back at current high market rates. So this also has the effect of, well, reducing their kind of cash flow, but inflating the assets of the investor. But it also means that company is a lot more fragile to financial stress because they don't have this clear asset that they can go to lenders and borrow against as collateral. 4, hefty management fees by the company to the private equity outfit, regardless of performance or indeed as they are being run into the ground. And this reflects a sort of shifting of risk. So by charging a sort of commercial fee, they're able to extract money that the company might otherwise not be able to use, say because they need to have a buffer for pension obligations or other liabilities. So this is, quite a clear risk transfer. Number 5, aggressive cost cutting. So CEPR research found average wages fall 10% after 1 year and nearly 20% after 3. So this is a significant shift in income from workers to investors. But more broadly, it sort of risks fracturing the work culture, fracturing staff goodwill, and by extension, perhaps the customer experience. The other aspect of cutting is cutting quality and cutting services whilst hiking prices and adding sort of hidden fees, which I've personally experienced. And this also impinges on the customer experience and, dependent on the industry, risks the long-term viability of that company. Okay, so what's the result of all of this? Well, average annual returns of 13% compared to 8% equivalent for the S&P, which, to be frank, isn't a whole lot more given the catastrophic side effects. But even chunkier than these 13-20% returns, it's just phantasmagorically larger for the private equity partners because they only put in a tiny slither of the equity investment, but they tend to command 20% of the total realized return on that investment, which is mind-boggling. So you can understand, with these kind of crazy sums being created from nothing for the private equity partners, what's incentivizing this really extractive and exploitative behavior. So I'd be interested to know what your thoughts are. Do you kind of support private equity? Do you think it should be regulated? Do you think it should be, prohibited entirely? Yeah. I think for me, it's pretty clear this is like a net negative for everyone that isn't a private equity partner. Even investors really may be hit by the blowback from this. Like, this is stratospherically increasing systemic risk in the economy, and we don't know where it's going to take us, other than that it tends to be the taxpayer and all of us that pick up the bill. That's what happened in 2008. And I think one thing we should be really clear on is, if we come to this situation again, which is looking more and more likely, we need to make sure that there are conditions attached to this cash. This is not conditionless blank checks being written. This monopoly board needs to be fundamentally restructured, so it's not a rigged casino where the rich and the well-connected get to fleece the rest of us. This is a system that works for all of us. But yeah, what are your thoughts?